We're here in Monte Carlo for the Rendez-Vous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Bill Churney, who's the President of Extreme Event Solutions for Verisks. Bill, welcome.
Thanks for having me, Richard.
Bill, it's a very different landscape from the last time that we all gathered here in Monte Carlo for the Reinsurance Rendezvous. What's the message that you're bringing this year?
Well, I think what our clients and the industry is interested in hearing about is what to make of the catastrophe losses of the last 5 years. And what we're doing is trying to provide some perspective to that, to help people understand that the two key drivers of it are what we're seeing in terms of inflation, increased property values, and we're also just seeing some natural variability. We can't forget that 5 years ago we were just sort of coming off of a long hurricane drought, and now we've had a period of higher activity. So it's helping people understand that along with some of the impacts of climate change that are starting to make their way into the what we're observing in losses.
So you talked about inflation. It's clearly at the top of a lot of people's agenda here in Monte Carlo this week. How does that play into your function as a provider of catastrophe risk models?
Well, it's critical. Now, as clients use the models, of course, they're responsible typically for putting in exposure data. So we need to make sure we're educating people and provide them tools and solutions to ensure those values are up to date. If they're using out-of-date values that aren't keeping up with the severe inflation we've seen, the modeling results are going to be completely understated. And I think that's why you've seen some of these smaller events start to become become larger events.
So we've seen also discussion about insurers and reinsurers refocusing some of their capital, perhaps away from more heavily modeled lines of business. What does that tell us about their risk appetite?
Well, I think one thing we're seeing is people moving more into casualty lines. I think that reinforces the investments we're making in modeling those types of risk. We've been investing in that for a number of years, and the clients that we're working with there very much want to see that get to the point where property modeling has been. So better data, better analytics. So I think that makes sense. In terms of the overall risk appetite, I think that's just sort of a rebalancing, in the industry, and we're seeing a lot of companies, embracing that catastrophe risk and filling in that gap. And the use of modeling for natural perils has never been greater.
So I know that you've done some research recently that's talked about the much higher increase in average insured annual losses. What's sitting behind that?
Sure. So one of the things that, as I mentioned, people have been concerned about is over the last 5 years, the average natural peril losses that the industry's paid out have been about $100 billion per year, and that's about double what it was in the prior 5-year period. So why? Is that climate change? Well, our message is really the top two driving factors are inflation and the growth in the number of exposures, that variability. That's probably 80% of what people are seeing. There is an impact to climate change, and then in certain segments of the market, you're seeing just social inflation or inflation driven by legal and regulatory environment. So helping people put that in perspective is useful. So when you run all of our models on a global basis, we see an average annual loss of over $120 billion. So we think the models are well capturing the risks that we're observing today. And what we've seen over the last 5 years should not be looked at as an outlier.
So one of the common criticisms of the insurance industry is it's looking back, it's solving the last problem, rather than necessarily the problems of the future. How does the insurance industry overcome that, and what role do companies like yours have in that?
Well, I think from a natural peril perspective, I think that's one of the things that the models can help the industry with, and have done so for the last 30 years. It's why the industry has, weathered a number of very severe years, without dramatic impacts. I think I would encourage people to look into the models and look at some of those severe scenarios. We don't need to think about climate change to know that this Atlantic hurricane season we could see a storm that causes $150, $200 billion in insured losses. Companies can scenario plan around that and understand are they ready for it. So I think the models provide plenty of tools to help people look at that and be ready to help society get back on its feet after such an event.
So you talked about the investments you're making in casualty models as well. Tell us a little bit more about that and what we might be able to see in the future.
Absolutely. So for a number of years, we've had a solution out in the market called Arium. We have a number of clients, insurers and reinsurers who are really at the forefront of analytical thinking who are embracing that. And what that helps clients do is across the range of casualty lines, look at different types of scenarios. It helps them improve the quality of their data, understand some of the correlated risks that exist in the portfolio, even correlations from casualty back over to property, because one thing we're seeing is some of the natural catastrophe events are having overlapping impacts, and the climate change issue is not just a property issue, it will impact casualty as well. And as what we're going to see going forward is it moving into more of a stochastic modeling approach that's very similar to what we've seen from a property perspective. So we think this is an area that's going to grow significantly over the next few years as more companies embrace that, they get better data, and they can start to use more data and analytics to help get their arms around this business.
Bill, thank you very much indeed for joining us.
Richard, thanks very much for having me.
For AM Best TV, I'm Richard Banks.